questions or anything you want to go over, just let me know.
Yeah, one of the things that I was getting a little confused on were sometimes when you look at the indicators, you talk about them having room to run, you know, when things start lining up for a good trade, like going long, for example, and then you talk about the indicators having room to run.
Like, for
Uh,
example, in this zone right here is kind of probably where I mentioned something along those lines. Because, I mean, sorry, finish the question.
Oh no, no, that's right. Yeah, I was just waiting for my screen to load. Yeah, exactly. Those indicators down there. Could you go into a little bit of what kind of I don't know limits you're looking at? Say when this indicator gets is at zero, for example, it has room to run up to 100 or something like that. I'm not quite sure what uh, those levels are that you're looking at.
Yeah, absolutely. So, when I'm talking about something having room to run, what that means is, for example, if we're looking at this area from this downplay and moving up, I would be saying that this would have room to swing upwards because when you're looking at the MACD, you can see we're heavily oversold right now. And you always want to look at things in relativeness. So when you zoom out, you can see the exhaustion levels based on other points when prices pull down or hit certain key supports or resistances. So when I see something pull down like this is something where I'd say, okay, we have room, plenty of room to run up, but not much room to run down because we're oversold right now. Whereas vice versa, if we, because I can look at the historical data, if we were over here, for example, we have a little bit of room to run up because we have room historically. We've seen, if I zoom out, that this up here, technically speaking, would be considered overbought in this zone. Then you can always go back to the chart and kind of see where price was at that point, at the highest. And that'll tell you when it was the most quote unquote overbought. And so when the chart's up here, for example, and I'm looking at all these other peaks, if price was here, then I'd say, okay, we definitely have a lot more room to go down versus up because we're overbought in the situation. And then if it's more of a 50-50, like what you were seeing in this little zone, like I probably was mentioning this around here because we crossed over, we had a bullish crossover, we're holding on the 7860, and I was probably saying more of like a 50-50 like coin flip because this is kind of where your MACD was sitting at that time. So it could run up or down at that point. It has room to go either direction because it's kind of more like that 50-50 zone, more of the zero median. The further you get away from that median, the more overbought or oversold. And then everything is relative. So now when I'm looking at this, for example, I can tell you right off the bat that just looking at this, if for example we were to push up and retest this 59.8K range, this is kind of where everything can tie in. So what I would do is I would look here and I'd say, okay, I can look at where the MACD was, I can look at where volume is, I can look at where the CCI is. And now I'm going to compare that to where we're at now. So I'll leave the indicator and you can see right now we have a lot more momentum in the market than we did at this point in time. So the odds of this breaking bullish and breaking out, if this was to test this resistance, is going to be higher if price was to continue to go up with the oscillators looking the way they are because there's more momentum. So we weren't able to break with not much momentum, but with this, we might be able to break that resistance. And vice versa. You've noticed a couple other times where I might mention, oh, the first time we tested this resistance, we showed this. And then the second time we tested a resistance, it showed this. So the likelihood of this breaking when this could not break is very low because this had way more momentum and all the oscillators leaning towards it being able to continue to trend up because of strength, whereas this it just didn't have the actual means to really get up there. So it would be considered a weaker resistance test because you don't have as much momentum, whereas if this did swing up and kind of test this high at about, yeah, I would say 59.8, basically 59.9, like super sniped in, just somewhere in that zone. If you see that the MACD has more volume And if you see that the VFI is higher, so if this volume goes up to here, for example, and we know that in this zone we were under the zero VFI, so we went from not being able to break the zero and failing resistance test to now the VFI might be able to break out. You can see this did pop over a little bit more, but we pulled back under. This is that pullback that we're seeing right now, and we're seeing the potential of this swinging up. So if price wanted to go up from this point, whenever it wants to find a floor or whatever it may be, once it starts to swing back up, notice where the point of control for volume just changed to also. It's literally at that exact zone. So that's going to also be an indicator or a confluence that you could say that price has a really high probability of getting back to that magnet, point of control for volume. And then when we get up to that zone or any of these zones, you can compare and contrast what the MACD is showing or the volume is showing and say, okay, well, we're coming back up to this zone. We're about to test 59.8, for example. And now when we're here, I can see that there's more volume, there's more momentum, and the CCI in this situation would have plenty of room to run up because we're more, this is what I would consider 50-50 land. So anything here I would call a coin flip. And then normally with the CCI, I use it specifically because it's a little more predictive per se than some of the other oscillators and stuff. It'll typically give you a tap out of these ranges before you get big impulse moves and stuff. So even at this point down here, you're still moving sideways, but you start to get a little bit of a break on the CCI to the bullish side. And that would have been the first indicator, especially that you're breaking trend in a bullish crossover. And as downtrend is getting broken, you have the volume inflowing, you have momentum flowing in, and you have the CCI starting to kind of test this range. The likelihood of this breaking up is very high, vice versa. If this continues to kind of pull down and you see the CCI tap into this negative 100 and lower range, then from that point, the likelihood of this pulling down for a Fibonacci retracement is a lot higher. So I like to use I use the CCI specifically instead of using like a stochastic or an RSI, just because I find it personally to be a little more predictive. The RSI and the Stoke, they work really well. They all work great, but a lot of them are just a little too slow. They're just a little more, uh, like I've said it before, Captain Hindsight style stuff. Like if you see a crossover on a moving average, the move, whatever caused it to dump or pump, already happened before you actually see the cross. So by the time you see the cross and say, oh, there's the death cross, the big sell, one of the major sell-offs had already happened. You might get lucky and catch a second swing, but you're kind of late to the party at that point. So that's kind of where all this ties in, is just being more predictive. So, instead of just being like, oh, now price is up at 59, now what? And kind of just like shrugging, we can look at this and say, cool, well, if it does come up here, I would have pretty good faith that if we want to come up and let's say we do reject at first, I would not be surprised to see this, maybe let's say swing around here, come back down, test this range, come back up, come back down, test the SR flip out of the liquidity zone, and then, potentially get that break up. Just a little bit more of a zigzag. That's kind of how the market likes to move in general. But I wouldn't be surprised to see something like that. And especially with more volume and more oscillator, more trend, more everything kind of leaning with more strength. And that's how you compare and contrast historically. So yeah, and then vice versa. If this swung up and we started to see this play up, but at the same time, I'm noticing the MACD is trending down. And at the time that it's testing resistance, let's say the MACD ends up pulling down to 35. Then at that point, I can say, okay, well, there's actually less momentum and trend than there was previously. And we weren't able to break this before. So the likelihood of us breaking it right now is probably not very high. Now, if we wanted to pull down and gain a little bit more volume and momentum and come back up and retest, maybe. But at this current moment in time, based on what this information is giving us, it's just not the best probability. Because again, it's all probability. So the stronger your confluence is, the higher your probabilities, the higher their probability, the higher your win rate and success rate. So hopefully that kind of explained it. I know I went a little bit more on like a full tangent on it, but I think that's like the best way to, fully describe all of it together, just so you can get a good idea of gauging where price could be going next and And it works for supports and stuff too. So if you see this pulling down, you can always watch the oscillators, and they're going to give you a really good idea of, if this is a really good, if it's a hidden bullish divergence, for example, you're going to see that really strong downtrend, something like it would look like this, so something along those lines. But you see price do this, then for example, that that's going to be relatively oversold in comparison. So if price is already oversold, but we have a higher low at the moment, the likelihood of this continuing down is going to be probability wise lower than if this was sitting looking like this, for example. Boom. If it was like that, then this would be a different conversation. This would be, okay, I would think that this could definitely continue to slide down and this has plenty of room to go down from here. So me watching this divergence at this point might not be the best time to watch it, because this still has plenty of room if it wanted to at this point in time to go down. Obviously it didn't, but you don't know in the exact time if it's going to do that or not. So being able to understand that, and that's another key point of divergences too, is you might get a bullish divergence, a regular divergence here, but when you're looking back, you can see that this zone is not as oversold as you'd want it to think. Whereas, a divergence from here to here, that could be a pretty strong regular bullish divergence, because this is already showing that it is relatively oversold. And if you continue to zoom out, there's only one other area really that put more selling pressure down from the zone. And this was back in, about 5 days ago. So, and then you could always look back and see what happened at that day. What caused that? Oh, that was the really fast sell off, that really took us down from, what is that, 70,000 down to about 49,000. And if you go look at this closely, we'll zoom in on that little area and see what the CCI was looking like. Zoom in, you get a little bit of a chop. And notice where your CCI is pulling first. Yeah, you do get that little up test, but when you're looking at this as a whole, and if you're looking as a support, like, is this going to hold as a support or is this going to go as a resistance? At this exact time when you're watching it, I would say, okay, well, we're definitely rejecting the 0 VFI, so that's not the most bullish thing to see, especially when you're supposed to be holding a support. MACD also is failing to get over the 0 VFI, or 0 point on the MACD. That's also relatively bearish. It's definitely holding more bear in this moment than bull. And then I can go to the CCI and I can say, okay, even we are pulling down pretty strong, and I've seen in comparison, we've tapped 1, 2, 3, 4, 5, 6, 7, basically 7 times to the bottom versus a couple, 1, 2, 3, 4 times to the top. And next thing you know, as this continues to work itself down, you get a really strong CCI sell-off from top to bottom. Boom, basically a really strong push. And when you get that really strong push to oversold, then you can see from that point, within a couple hours, price really starts to wean down and kind of take more weakness. And every time you start to see that CCI pull down as well, and the volumes start to kick down and kind of put red indicators all stacked together as a confluence, price will push down with it until we get far enough down to where you start to get an oversold on the MACD. You start to have at least some sort of volume hold. You flip bullish in a volume and you don't really flip back with a red signal, so that's a good thing to see. And with your CCI, you get that regular divergence where your oscillators are finally starting to trend up even though price is going down. So CCI would have given you that little indicator of that potential for a divergence, and then the MACD being relatively oversold. Just looking historically in comparison to everything else in this zone, you can see that it was oversold to shit. There's really nothing that compared. So because of that, that could have been a really good time to buy that bottom, knowing in relativeness that this is extremely, extremely oversold. And then this from here obviously would have way more room to run up versus down, because the likelihood of this continuing down, especially when you're already these numbers are insane down here. This is normally where you see it get to about anything under -1,000 is pretty much normal. Anything over minus 1,000 is extremely oversold. Vice versa, over 1,000, extremely overbought. You can look over here and see what happens at this zone. So it was the peak when it hit extremely overbought on the MACD, and then from there kind of hit lower highs continuously until we're kind of, getting to where we're at now. But yeah, that's how I tie those the overlays, oscillators, and everything in, so that you can kind of get a good idea of how price can react, because historical information is going to give you everything. So if you can find out what happened historically and where all the oscillators were sitting at that time, and then compare to what you're seeing at the current moment, you're going to increase your odds significantly.
That's very helpful. Thanks, EQ.
Yeah, of course. So like even now, for example, you're watching this double top. You already got your spooky. You can already see pretty clear. You're trending down at the moment. So your momentum is pulling down. You have the potential of holding your point of control of volume at the moment. And again, here's another retest. So if this fails to break zero, like we were just talking about, that's going to give you another sign of maybe this might not be the best time for this to break. CCI pulling down, getting pretty damn close to, flashing for the first time in those under negative 100, but we're not there yet. And from that point, that's kind of where I'm watching this now. You're showing the McDonald's sign, what we were talking about yesterday, or when I mentioned a couple days ago. If you see the W, that's when everyone's quitting their jobs. If you see the M, that's when everyone's going to be applying to McDonald's. So you're starting to see that M double top formation, lower highs, and you're getting the confluence because you're getting lower highs in price and you're getting lower highs on every oscillator. So that would be a confluence in price, or a convergence is what they call it. That's like the technical term. The opposite of a divergence is a convergence. So when everything is converging in the same direction, then that means that the likelihood of this continuing in that same trend is high. So something to watch for as this pulls down, and some key levels. And if you're watching or if you saw that post that I did earlier, I can show you a video example of what I was talking about. So when you're using a fib, you can always range your fib, and it's not like it has to be predicated to one area. So before I even did the fib, I was looking at this price range at about 55.5, just because of all these SR flips and liquidity tests and things that are kind of going on historically in this zone. Support test, support test, support test, massive dump, resistance push immediately the first time we test, impulse move over it. So I like this little zone specifically to see if price can hold. And then from there, that's where I add the Fibonacci for confluences, so top to bottom, or bottom to top, because it is a bullish move. When I do this, you can see I'm pretty damn close to getting it on the 78.60 in the zone. Now, if I pull this down to the next range, let's say down here, you can see now we're right in the golden pocket in that zone, and then pulling it down even more. Now we're just at about the 50 for that zone. So everything will match in terms of your Fibonacci's. So if you have a specific support and resistance that you're watching, that at any time, no matter if it's a short, medium, or long-term Fibonacci, and you're still getting these confluences of price being able to hit a certain range, that's a good thing to see. So I'm definitely watching this at the moment and just waiting to see if we're going to pull back. And again, you can historically pull this back even more and see that this was a major liquidity test previously. We pushed from 55 to 58 in a matter of, let's see, 1, 2, 3, in like less than 24 hours, basically. So the impulse moves are there. The opportunity to hold is there if price wanted to come down. We are in this bearish crossover on the hourly. Always something to keep in mind. And then let's go 4 hour. Bullish crossover on the 4. Good to see. We're just like dead set in this move right now. But I'm happy that we broke out of this bearish, the falling wedge. It's always a good thing to break out of. And going to daily. Again, played back. This was always in a bullish crossover the last basically couple weeks. That was like, yeah, about 10, 11 days. So the last 11 days, we've been in a bullish crossover regardless of this price action. And we all know crossover strategy will tell you if you're in a bullish crossover and price pulls down, the likelihood, especially on longer time frames like the daily, of this being a fake out is significantly high. And zoomed out on the daily, you can see we were able to test major liquidity at the bottom of the range, which is exactly what we wanted. This is a triple bottom test at this point. First test was all liquidity. There was only lower wicks. Second one was just a quick in and out on the daily, so not much time to confirm. This time, finally, we were able to have a day of settling down here to confirm that we did want to hold price. So that's going to be the differential in all of these support tests. First one is just a straight liquidity grab to a pump. Second one, you test lower, more of a liquidity, but you never really get a full body close or anything that tests or shows any sort of market indecisiveness or anything like that. And then you go to the third test, and you get that doji, and that doji is going to be your first sign of market indecision. And the doji would be the first telltale sign of maybe we're going to go into the opposite direction now, because we've officially confirmed this price between 53.7 and 54.8. We were able to compete and confine price within a, I would say, 0.5 maybe. That was close. Zoom that out, make sure I'm actually accurate. Yeah, so you're looking at about a, yeah, okay, so 0.4%. So your total volatility within that day was only 0.4%. So with that in mind, I would say, especially when you're seeing days after days of extreme volatility, extreme volatility, extreme volatility, extreme volatility, extreme volatility, then you finally get a kind of calm, indecisive day in the market, and then back to volatility and volatility. Now, if this day ends as a doji, like I said, keep an eye on that because that's indecision, but I am looking at this to play up a little bit once we get that hourly support hold, obviously, and this decides to play itself out, and we figure this out and go bullish again on the daily crossover, or sorry, on the hourly crossover. Once that goes bullish, then we could get back to moving up. Now, based on this Fibonacci move currently, if we do pull down to the 7860, we know that that likes to hit take profit 3. If I extend this out a little bit more, we can see that take profit 3 will test that downtrending resistance that we've been watching on the longer terms, which is what I'm looking for major weakness right now. So I want to see price swing up. If this tests the 7860, that's fucking incredible, because then we can hit take profit 3, which is very doable based on that Fibonacci standard. That take profit 3 will also confirm this downtrending resistance if it wants to stay as a resistance and play down, or we could theoretically see this break up. Now, me personally, I don't think that's going to happen where it breaks out. We'll take a little bit of a look-sees like we were just talking about, Brian. So you have resistance, resistance. If this want to play up and hit a resistance, you're going to look at your volume and your oscillators to see what's going on first. Now, I can see clear as day that volume was higher here than it was over here. And if we had less volume on this side when we go to test, if we weren't able to break a resistance on this side and we couldn't break this resistance with more volume, I would be very inclined to say that this will, if this did push up, it would reject and confirm a resistance more than likely, just because of this volume in comparison. Now, if there was a huge injection of volume by the time this got up there and we were able to make this, let's say create new highs in volume, sure. But let's say volume only hits the 0 VFI, for example. Let's say we push up and hit here, and that's where we make that test. If I see that, then I would be looking for a rejection, because I could see clear as day that if we didn't have the volume in these two zones and couldn't break, especially this one, then I don't think that this would break with less volume. And then you would be looking at the oscillators. You can look at everything else that'll tie it in together and kind of give you a better picture too when that time comes. Because right now there's not enough information to know exactly what will happen because we haven't even pulled down on the Fibonacci yet. So we don't even know if this take profit 3 is technically theoretical yet, or if it can be a play, or if we're going to pull down and reject, or maybe I got to pull down this Fibonacci to here because we double bottom. Like I have no idea right now. So that's kind of where this predictive side comes in. You can give yourself an idea, but understand that you're not God. So no one's trades are going to be perfect. And just because it looks amazing doesn't mean that it's going to play out that exact way. I could say even in the last few days, yeah, I'd say the last week would be a great sign of patience equals patience, because as the market dragged, I had, plenty of opportunities to cut my losses on those trades and do what I needed to do. But as I'm looking at the charts from my perspective and I'm seeing these oversolds and I'm seeing price hold, in my mind, I know that we're getting damn close to a hold, but everyone has to just keep in mind that this market is built to crush people's psychology. Everything is built on market psychology. Even the idea of using Japanese candlesticks is literally based on market psychology. That's why we don't trade lines, we trade sticks, because the lines will just give you price, but they don't tell you market psychology behind it. It won't tell you if there was high selling pressure at the top end or any of those other things. The line will just give you the average price, but you're not getting the story. Whereas the story of the market psychology will come into play with the candlesticks. And I feel like a lot of people just don't talk about that. I see people talk about it on TikTok and stuff like that and YouTube, but I don't really see anyone break it down to a true definition of like you're trading psychology at this point. If you are a Japanese candlestick trader, everything you're predicated to is going to be market psychology. And with that in mind, if you know that people are going to be getting bled out, if the market is boring and it's not moving in a direction that's common of a sell-off, then sometimes you just have to sit it out. You could see a really good trade setup come, but the hardest part about trading is timing. It's almost impossible to time something to the exact minute of when it's going to happen. So you could see something becoming bullish, you could see a trend forming, you could start to get into it, but you'd never really have an idea of if that trend is actually going to take form in a day, in an hour, in a week. You're just there and you just have to wait it out and see what happens. But there's no really way to tell exactly when things are going to happen based on time. Now, I always try to go the opposite of everyone else, especially when I see people posting like older charts and older things. Like if I see people that are still using like a market money analysis that was created in like 2010 or 2017, or like the rainbow charts and all those things, I don't follow them because they're all out there for a reason. And if you just keep in mind that 90% of traders are losing traders, that would mean that the majority of information you're being fed is in some way incorrect. It might be 90% accurate, but the 10% that's inaccurate in those posts is what's going to cause you to lose money, for example. So I saw that post about money flow, and it showed like an extreme sell-off on the money flow chart, and that's not necessarily how it looks. And I could see why people would get crushed in those situations, because they would see Bitcoin sell off and go, oh, I'm going to go buy my altcoins now. It must be altcoin season because it dumped and now we're sitting in the bottom, when in reality, the worst altcoin seasons are at the bottom. So you don't want to get into an altcoin season when price is accumulating. Like altcoin seasons down here suck. Altcoin seasons down here suck. Like you want to wait until Bitcoin actually takes off and starts to gain some sort of market dominance. From this point, this little area right here, I'm sure had a really good run for alts while Bitcoin was going sideways, because you're taking out money and you're distributing it to other altcoins for that second push. And I'm sure from here up, a lot of these altcoins ran with Bitcoin, but that first move, Bitcoin is going to be the first one to run it. And then the altcoins follow, because the money is going to start to distribute when it's at the top of certain moves from Bitcoin, and it'll distribute through the alts. Because let's say Bitcoin runs up to, right now we're at a $1 trillion market cap, and it's over 50% of the total market cap for the entire crypto market, which is 1.89, I believe right now. Let's see how close I am. 1.96. is the actual number for total market cap in trillion. It would be safe to say that if Bitcoin was going to take a run or a move, uh, don't crash on your computer. Can you guys still hear me? See if see if it comes back. Oh, we're back. Okay, cool. Whew. Sweet. Lost it for a second. Yeah, no, I was in the. I just start to see my mouse go slower and slower, and I'm like, hold on. I don't think this is supposed to be doing this. Oh, let me try to close something real quick. Maybe that'll help. Cool. So, ADHD brain. So yeah, with these altcoin seasons and stuff, you want to see distributions first. Like if you go look at uh, total market cap 3 is going to be altcoins as well, excluding Bitcoin and Ethereum. You know, obviously I've been watching for some key zones for this. So right now for alts could theoretically be a good time to do this if Bitcoin did want to push up. Now these are my sniper entries for longs, sniper entries for shorts based on market caps, based on total 3. So again, if a trade did want to, if we did see total 3 push up to about 7.5, for example, I would love to get into shorts up here and ride the market down. You can see this long-term downtrending resistance on the daily at about here. So if that did want to break at some point, now if you're looking at the dates on the daily, this is a really key part of this as well. So I would be more inclined at this exact moment to say that this is probably going to be what it more so would look like. Let's say Bitcoin want to take a little push up, hit that resistance. I could easily see us swinging here, 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 all the way through. Boom. If you go look at the dates down here, look at this is November, December, and then going into January will be just as this long-term downtrending resistance meets up with this liquidity zone down here, just literally right when it's hitting into January. So I would be watching this, you know, for the rest of the year to kind of play out in this general realm until we get into and past election season. Something like that is what I would be looking for. Now, are we actually going to hit this resistance every time? Who knows? That's going to be the fun part because we haven't actually done that. So this is our liquidity zone right now. This is the first little test that we saw, that major sell-off, but we haven't actually confirmed with price action down here. So we could see it go like this, maybe something like this. You know what I mean? So it really hasn't gotten down to this zone yet. So it's playing down, but we've seen 1, 2, 3, 4, 5 tests on this resistance, this downtrending resistance. So I wouldn't be surprised to see it go bing bong, and just continue to hit it over and over again until we finally break out long term. Now, this looks like the perfect drag out. And you know me, what am I going to put down here? Good old Fibonacci. I'll put money down that that's at least a 6180 or 7860. Yeah. So right in the EPIQ golden pocket, the new name, you can put a nice rectangle in this zone. Anything right here is money. That's, you know, the most ideal place you can get on a long term. And this is taken into consideration from October 2023 and on. And if you even zoom out further, you can even follow this exact Fibonacci from 2021 through, because we did hold. So this looks like a 7860 or a 6180. This looks like a 50 on the longer terms. So you can even go 2021, stretch it all the way across. There you go. So bear run holds 7860 in the bear run, holding the Fibonacci perfectly all the way through the bear run. You pushed up a little bit. Now we're holding at about the 6180 and going into the 50 range. And if this does hold and continue like a Fibonacci would, we can see total market cap for altcoins, because this is excluding Bitcoin and Ethereum, getting up to about $2 trillion market cap, which is absurd for altcoins. That's everyone excluding Bitcoin and Ethereum would get $2 trillion worth of money if this Fibonacci played out. But this Fibonacci has been accurate and has played consistent since 2021. And all these zones in the bear market, especially for altcoins, were all literally like the perfect zones for accumulating and buying for long term. Now, that's the difference. If you're just buying to jump into a super cycle immediately, it's a little more difficult to time. That's why you see me just buying in different sectors and different assets and holding it, like the people that would have done it down here, and waiting until those actual super cycles play in, not jumping into them, but you want to get in as an institutional trader. That's kind of what we're trying to do here, is think everything institutionally, think everything on a bigger scale. Everyone is so stuck in like a closed-minded, short-term mindset in this space. I see it all the time on TikTok. I watch it on people's live streams. I keep up with everyone, but at the end of the day, I don't listen to what anyone else really says. I just like to listen to the news and take what I like to take out of it. Everything is a grain of salt for me. But, I would not be surprised to see something like this. And I anyone in here can, obviously say otherwise, or say if they maybe there's another type of setup or anything, but I would be pretty inclined to assume that this could be exactly what it would look like going into, remember, we're going into FUD season, we're going to elections, everything is going into a stagnant downplay. The market is just dragging right now. So with those drags, I could easily see this pull down, and it's just the timing on this is too convenient. Right as the election would end, you're getting to December, you're getting into that point, and now you're getting to that really magical double confluence right here of two 6180 stacked on top of each other. So again, get another zone. Anything that landed here is like probably the most money of money. So you're watching these long-term confluences of things that take years to play out. Like this isn't just like a 1 hour Fibonacci. This is a Fibonacci that's been playing out for this shorter term, been playing out for the better part of almost 8 months. And oh no, wait, this is a 12 month at this point, because I started October. Yeah, so this is almost 11 months at this point. So this is a full year in play with this Fibonacci. And when you're looking at the even longer term Fibonacci, you're looking at a 3 year currently Fibonacci play. Well, 4 year from December of 2020. So you're getting to about 3 years and 9 months. And it takes a long time for these things to play out. But, if we saw 1.1 basically in 2021, and now we're going to see double that this time. Now, keep in mind, there are a lot more altcoins, but the amount of altcoins that actually end up getting over $1 billion of market cap is relatively low in comparison to how many there are. And you got to think about how many billions you can put in a trillion, and then think about 2 trillions. So there's a lot of money that could flow into altcoins. They don't really need that much money to pump, for majority of altcoins. Hopefully CoinGecko isn't the one that crashed the computer, but unless you're in the top 10, like even Toncoin, look at the differential. Toncoin is only sitting at a 13 billion market cap. Only, quote unquote. Tron, 13 billion. Even with all the pumping it's done. Cardano, 12 billion. So these are fractions of what would be in a $2.1 trillion market cap, because you're going to take out these two. These two won't exist anymore at that point. So you're looking at total market cap. Total 3 is going to be excluding Bitcoin and Ethereum. So they're not taking from that number. It's going to be everyone else, which is going to be mostly stables at the moment. Tether, USD, C, and you're going to see more of them starting to pop up on this list more than likely. because stables are always popular, especially during a bull run. You'll see right before a bull run takes off, the stables will all end up on the top of the list because people are getting ready to buy bags. But even to get, let's say, even top 15 right now, you don't even need to have $10 billion market cap to be top 15. So you could have what 100 AVAXs stacked on top of each other and have a $1 trillion market cap. So if you think of it from that perspective, even the biggest projects are only taking a very, very small fraction currently of that 2 trillion that could be potentially available at the peak of this next super cycle. So there's a lot of money to get thrown around. Uh, yeah. So that's kind of what I've been watching and looking at, and just I'm trying to make sure that I kind of keep everyone in a longer term, in a more grandiose mindset, I'll say, just because the sky's the limit for all of this. To be even completely honest, just to even take it off of trading, I see it in terms of money. I see it in a lot of ways. People get stuck. I mean, even for me, I left I lived in Gainesville, Newberry area for like 3 years. And honestly, I ended up leaving because I've lived in big cities my whole life. I lived in Miami and Denver. And then I was like, oh, I want to live in a small city. I want to live on the countryside. And no pun intended, it was just such a small minded community that they just, it was a bubble and there was just no growth. Whereas, being in Miami, for example, they call it the entrepreneur's paradise because being here, you start to really understand that money is infinite. There's literally, it's unlimited. There's so much of it, even in just one city. So if you just take one city and compare that to anywhere in the world, like money's infinite, everything is infinite, all the scaling is infinite. Even look at space. Space is infinite. So people just like short-term things, short-term gratification, get rich quick schemes. That's why meme coins do so well, because everyone just wants to get rich quick. No one wants to actually put in the work. No one wants to actually make things happen. They just want to win the lottery. That's just how people are wired. And so when you have a guppy mindset, it's very easy to get swayed on the day-to-day volatility of the markets. Like, oh, today's going this way, oh, tomorrow's going that way. And you start panicking, and next thing you know, you're spending every waking minute looking at the charts, and you can't even go an hour without checking your portfolio or checking a trade or checking this or checking that. You're in the trap at that point. That's where they want you to be. That when you can just, in reality, just step away from it and take a look from a more macro perspective and understand that, patience is patience and everything is going to work itself out. And as long as you're not putting yourself in a position that you're, let's say, over leveraged, or at the end of the day, you don't have to liquidate. that's If you liquidate, that's on you. That's the best way I could put it. Especially if you're investing in like a safer project. Like for my trades that I swung down, I can tell you with 100% honesty and certainty that if those trades were not Bitcoin and Ethereum, I would have taken the stop losses and I would have gotten out of the trades. Why? Because there's just way more volatility in the altcoins, and I don't have that much faith in any other project or projects besides Bitcoin and Ethereum that would have a guaranteed certainty that they would play back up. So when I'm watching Bitcoin and Ethereum go down, that to me, I'm not necessarily as phased, and I have no problem kind of slipping down my leverage and putting more of my quote unquote own money into it, because that's all it is. When you're turning down the leverage, you're not gaining or losing any more money. You're literally making the same amount. It just depends on how much of it is actually your money and how much of it is borrowed from someone else. That's the only difference. But if I'm running if I started my trade at 10x and I brought it down to a 5x, I have more of my personal money in it, but I'm still going to be getting the same P&L. I'm still going to be making the same amount in that trade when it swings up to a certain price, regardless of what percentage or what X I'm running it at. So by just, some people just shoot themselves in the hand. And I mentioned it in a video, I'm like, even running 2x, you're doubling your money. 3x, you're tripling your money. 4x, you're quadrupling your money. If you think about it from that perspective, you don't really need to go any much further than that. Like that's insane to think about it, even just from that perspective of, oh, I could put this in and, I'll whatever I would have made, I'm gonna automatically triple that. Like, what other places can you do that? What other markets could you do that? Where, people just get greedy and that's why they turn the numbers so high. That's why you see exchanges put it to 150x. Because then in your minds, you're looking at it as a median. So you say, okay, well the scale goes from 1 to 150. So I think that means that 75 might be a decent average pick because it's right down the middle. That couldn't be far further from the truth. So everything that you're given, everything that you're seeing, everything that you're told, all of that, just remember that there's a reason and always ask the question, why? Why am I reading this? Why am I being told this? Why is this news article in my face? Why? All of it. Just question it and come to your own conclusions on it, because I don't know if you saw the video that I posted about, hate 'em or love 'em, the Andrew Tate video about mass media and their control on it. It's 100% accurate. I learned those exact things getting my master's degree. My teachers that I had quite a few teachers that were CEOs, CFOs, CMOs of Fortune 500 companies, and they all said the exact same thing. Like, it's 100% accurate. Whatever you're being sold, especially in news, you're digesting it for free. What other business is there that you're just being fed things for free all the time? Unless it's social media or Facebook or anything like that, because you're being fed ads. There's a reason why the narrative is being driven by the super rich and being fed into the media, which has no return on money because no one is buying mainstream media. So all these billionaires and trillionaires and companies are injecting so much money to mainstream media to influence people to feel, act, do certain things a certain way, which will in turn benefit the super rich and the ultra wealthy in the long run. So all of that is just very important when it comes to trading, and just understanding that there's a lot of bullshit in the market, and especially from a long-term big perspective, when you have more institutional money in a market as well, there's going to be more institutional influence. And that's what makes the psychology so important in all of this, is you're not necessarily trading price action, you're trading human emotion, and you're trading, I mean, literally, it's human emotion. Think about it. What happens in a black swan event? Everyone shits their pants and they sell because they're terrified. What happens in a bank run? A bank run happens because people start shitting their pants and they lose, and they take all their money from the banks, and then the banks don't have any more money because they were loaning everything out 9-1, and now they don't have shit. So, and vice versa. What causes markets to pump? People go fucking crazy about things and make prices go parabolic because of human nature, human drive, human desire. Again, that's why we trade candlesticks and not lines, because humans are what drive the market, not price. So I think just even having that mental perspective difference and just a change in it of looking at everything instead of just looking at it as a number and looking at it as a psychological point, you can really, really find key points in the markets where you can inject and just absolutely bleed people out. Because I could tell you right now, just from looking at this, I did drop this, but if we did swing up here and hit this resistance, and this came down, and we actually sat down at this $450 billion range for 1, 2, 3, 4 days, I would be very safe in assuming that probably most altcoins would be down about at least 50% at that point, especially if it sat down here. Because the longer that things sit, the more that people are just driven in that indecision and fear. Just think about how it felt, the last week, just watching Bitcoin. Like, it's like, oh, it looks kind of bullish, but then it just keeps slipping and keeps slipping and keeps slipping. And then what happened? The last couple of days, you start to see other people talk about, oh, the market's just bleeding out. The market, it's just doing this, it's doing that. I'm looking at all this and I'm saying, okay, cool. Everyone is starting to flip back because everyone's like flip flops. They just like to thong around and flip back and forth because they're short-term mindset. So as we're dragging through the last few days, I'm seeing everyone else going, oh, looks like we're just going to continue to drag down until the election. It's going to take a I saw, I'm not going to drop the name because I actually do like his content, but I was kind of shook. He had mentioned, he's like, it'll take a miracle to see price action move up over 55,000. I was just like, what the fuck is this guy talking about? And I'm like, what? So once I start to hear those things and I see people talking like that and I see the analysis in the markets, and I'm going to go against the grain pretty much every time. If it looks like shit and it's dragging out, I'm going to swing it to the upside. Because when a market is actually going to continue to play to the downside, it doesn't drag down for days, it'll drag up for days. It'll look more like this. You'll see things like this, but in vice versa. If you're going to continue a drag, it's going to kind of play in the opposite direction before it continues. It's not going to downplay and then drag down. It would look more like this, like what you see here. This would be more considered a relief push up. You have this uptrend, and then you have, boom. That would be considered, a continuation of this going down. But you did not get that type of price action in the last few days. In the last week, it was going down, which would be more of a sign of a flip back into a bullish, or at least some sort of wedge being created that could swing back up. Now, if there was a major sell-off and let's say price, instead of going down this direction, was, let's take this line and move it here. If price started to move like this after that sell-off immediately, that would have scared me. That I would have been looking at as, okay, this might be a continuation to go down. But price didn't move that way. It went the other direction. It just bled out so long for the last few days that, people got shook out of the market. And I would assume the majority of people, if they got into trades in the last week, let's say up in this zone, like where I got into, I would assume probably 80% of people that are running leverage, if not more, probably got out of trades or liquidated somewhere in here within the last 5 days. That's just a safe assumption. You could always look at the liquidation charts and it'll match it, but I'd be pretty safe in assuming that. And so again, that's why I want to see the swing back up, because I'm waiting for a max pain and critical bleed. I'm waiting for the psychology, and I know that if price wanted to go up, keyword if, test here, no one's going to actually see this resistance. Everyone is just going to see that price broke 60,000, and you can already imagine how many people are going to, start to perk their ears up and start to pump bullish content and, oh, we're back over 60,000. Oh, the 25 EMA is back under the 5 EMA. Like, here we go. Which, by the way, if you guys are using EMAs, please, if you're using any moving averages, please, for the love of God, do not use EMAs. Use SMAs instead. Don't use EMAs. Don't use MAs either. Just use SMAs, simple moving averages. EMAs and MAs suck. They don't move correctly. They're very wobbly. They fluctuate the wrong ways. You want a simple moving average. So if you're using anything besides an SMA, flip it, because it's not worth your time. And honestly, EMAs and MAs suck. They don't do it. It's an exponential and an estimated moving average. So the EMA is not really giving you any sort of true information. It's just guessing shit. Whereas at least you're going to get something accurate out of an SMA. That was my one thing about them, because I do know a lot of people use them. But back to this, I could see it swinging up here and seeing everyone going crazy and going, oh, we're cross, we're bullish, this and that. Everyone jumps back in the market, 60,000, the bull runs back on. Next step is 120,000. I told you guys you should have bought the dip. You can already hear it in your own heads as I'm saying it, and you're probably like, yeah, that sounds about right. And then what happens? Psh, skyrocket down. We're landing the Elon Musk rocket back to Earth, and people are like, holy shit. So, just keep in mind that, again, we're trading psychology, not price. So I want to see this really get up here, and I want to really see everyone online and on social media and in the news and just start going so super, super bullish that I have no other option but to go into shorts and ride this down because it's inevitable. But yeah, if you guys got any other questions, let me know. Hopefully that did make a little bit of sense too, and maybe give you a different perspective on how you're looking at price and movement, and basically a way to tie it all together. That's basically a cheat code on how to tie in fundamental analysis into price action. Because if you're looking at everything from a psychological perspective, then you're not trying to do math of a what's a plus one. You don't know what that is, but you'll know what 4 plus 1 is. So you just need to convert the information so that everything is in the same formula. So if you're going to do it all, if you like to tie in fundamentals, make it so that your trading becomes more fundamental as well, where you're putting more of an emphasis into the psychological aspects of it, and max pains and market movements and cycles. And I'll even put the last note. One of the other big reasons why I was very bullish the last couple days was because everyone and their grandmother was talking about how it's red September this, red September that, September's the worst month, and this and that. And obviously, the first week played into that narrative, and everyone thought that they were Nostradamus. Everyone thought that they, could foresee the future. We had Miss Cleo everywhere, and next thing you know, it changes. So just keep that in mind too. It's just take everything with a grain of salt and formulate your own ideas. That's kind of what I try to do here with everyone too, is just, teach you how to fish, not just like give you fish, because I want you to be able to make your own decisions and your own ideas and your own concepts. And I know that I'm not perfect either, so I'm not going to sit here and act like Flosstradamus or anything like that. So I'll leave it on that. If you guys have any other questions, let me know. Um, and yeah, we'll just continue to watch this play to the upside and watch everyone kind of shrug their shoulders and say, maybe this is the year that September is going to be green. Yeah. And then they're going to get crushed the next 2 months. Um, but yeah, we'll keep this resistance on, keep it in check. Keep in mind that Bitcoin on the hourly is crossing, currently bearish. Let's see what it's looking like before I pop off out of here. Yeah, I mean, we're still holding at the moment. You can see volume is pulling up, which is good. Now, this would be your elf. If you're looking for an elf on the shelf, that's where your point of control is right now. So the elf on the shelf basically is just like a really quick support hold that allows what I like to call rockets to take off, like a support landing pad. So because this popped up and we have this double bottom with point of control of volume, if this did want to hold here, we could theoretically see a price hold here and push up from this zone, especially with the CCI starting to turn back up a little bit. Never actually reached oversold by any means. And here's a good time, Brian, too. With the MACD has plenty of room to still run up as well, because it has been in a downtrend. So if this did want to turn, we still have plenty of room to hit an overbought on the relative short term. And if you zoom out, we have a lot of room. And on the same side, we also have a lot of downside to run. So if this did want to go to the downside, for example, like this would be telling you that in comparison to what you see right now, this play has more room. If you're looking at the MACD, this play has more room to go down than to go up. So from here, I would be less inclined to be looking for long positions. I would be more inclined to look for shorts, because the MACD is going to be telling you as well, if you're able to catch the trends at the right time and you were able to get it maybe up here or in one of these zones, you could theoretically ride a really strong off sell and a sell off. So all little things to keep in mind. I'm not really sold on this elf on the shelf right now per se, but we'll see what happens in the next few hours. But yeah, I will get this up on YouTube ASAP.